Welcome to the VFX podcast, a space where we break down how markets actually work, beyond the headlines, beyond the noise. In each episode, we dive into the mechanics of price action, market structure, and technical analysis, explaining not just what happens in the market, but why it happens. We explore specific concepts, real trading behavior, and the decisions professionals make every day, from risk management to execution, from strategy design to market psychology. This podcast is produced by VFX, where technology and experience meet real market conditions. If you're here to understand the market, not guess it, you're in the right place. I want you to picture a standard stock market trade. It's just, the image that most of us have in our heads.
Mm-hmm.
You see a company you like, maybe they make great phones or that electric car you want. You look at the price, decide it's worth it, and you click buy.
And then the shares just appear in your account.
Exactly. The money leaves your wallet. It feels clean. It feels instant.
It feels like you just walked into a store and bought a loaf of bread. A pure exchange of value.
Right.
Ah.
But we're looking at this massive stack of research today covering everything from market microstructure to trading psychology and even a modern ecosystem called Vortex.
Yeah.
And there's one headline screaming out from these pages. It is that this clean image is a total fairy tale.
It really is. It's a comfortable fiction. In fact, economists, they have a specific name for that fantasy world where trading is instant and free.
Oh, they do?
They call it the Walrasian auctioneer.
The Walrasian auctioneer? That sounds like a character from some high fantasy novel.
It basically is. I mean, it's this theoretical idea of a magical, invisible figure who stands in the center of the market.
Okay.
He takes everyone's orders to buy and sell, and then, boom, instantly finds the perfect price where everything clears. No cost, no delay, no friction.
And I'm guessing the research today is here to tell us that the auctioneer is dead.
Or rather, he never existed in the first place.
Right.
Precisely.
Yeah.
In the real world, there is friction everywhere. And that's our mission for this deep dive. We're going to stop looking at the sticker price of the stock, which is what we call asset pricing.
Okay.
And we're going to pop the hood. We're looking at market microstructure.
The engine room.
The engine room. We're going to see the gears that move prices by pennies, the specific rules that determine who gets filled and who doesn't.
And the psychological glitches that cause traders to crash the car?
Yep. And finally, we'll look at a modern system vortex that's trying to navigate this whole messy road.
So let's get our hands dirty. The source material draws a hard line right at the start between two ways markets are actually organized. It talks about batch systems versus continuous markets.
This is the foundation. A batch system is actually how markets used to open and, well, often still do.
Okay.
Think of it like a morning meeting. Orders pile up overnight, buy, sell, nothing happens yet.
Just a stack of paper.
Exactly. Then, at a specific time, the market opens, an algorithm looks at the pile, finds one single price that satisfies the most people, and bam, everything executes at once.
Like a starter pistol going off.
Exactly. But once that pistol fires, we move into what we see all day long, a continuous market. And this is where the real complexity begins.
How so?
Because within a continuous market, you have two totally different ways to get a trade done. You've got dealers and you have order books.
This was the first big aha moment for me reading this. I always just assumed I was trading with other investors. But in a dealer market, I'm not trading with another person like me, am I?
No, you're not. You're trading against a pro, a market maker.
Okay.
Think of a deal like a used car dealership. They have inventory sitting on the lot. If you want to sell your car, they will buy it from you right now.
Even if they don't have a buyer ready.
Even if they don't. They provide immediacy.
That's the key word.
It is. You want out, you're out. But they charge you for that convenience. They quote a bid price to buy from you and a higher ask price to sell to you.
And that gap is the spread.
That's the spread.
Okay, hold on. I want to really drill down on the spread because normally I just see it as a fee, a transaction tax, so the broker can buy a yacht.
Right.
But the text breaks this down into actual costs.
Yeah.
And this concept of adverse selection just blew my mind.
It is one of the most profound concepts in finance, and it totally flips the script. I mean, usually we worry about getting ripped off by the dealer, but adverse selection asks, what is the dealer afraid of?
They're afraid of the guy who knows something.
Exactly. Imagine you are a dealer. You stand there all day buying and selling. Most people are just uninformed traders, retail guys, rebalancing a 401k or whatever.
Easy money for the dealer.
Easy money, you earn the spread on them. But then someone walks up to the counter who is an informed trader. Maybe they have insider info. Maybe they have a faster algorithm that knows a crash is coming in 3 seconds.
So if that informed trader sells to the dealer,
The dealer is left holding the bag. They're buying an asset that is about to plummet in value. They lose money. They have been adversely selected.
so they have to protect themselves. They can't just take that loss.
Right, and since they can't tell who is informed and who isn't just by looking at them,
They charge everyone.
they widen the spread for everyone.
That is wild.
Ah.
So when I pay a spread on my trade, I'm not just paying a service fee. I am essentially paying an insurance premium to cover the dealer for the times they get outsmarted by a shark.
You've got it. The spread is the cost of information asymmetry. If everyone knew the same things at the same time, spreads would be tiny.
The other cost I mentioned in the notes was inventory risk. This seemed a bit more mechanical, but it still drives the price.
It's equally important. Dealers aren't infinite, right? They have a bank account and a risk limit. If everyone is selling, the dealer ends up holding a massive bag of stock.
They don't want that exposure.
Of course not. So what do? They lower their asking price. Aggressively.
To tempt buyers to come in and take it off their hands.
Yes. And they lower their bid price to stop people from selling even more to them. They are literally manipulating the price downwards.
Not because the company's fundamental value changed.
No, but simply to balance their own books.
Which just reinforces the main theme here. Price isn't just value. Price is mechanics. It's supply, demand, and a dealer trying not to go broke.
That's the engine. So now that we know the game is rigged, or at least structured in a very specific way, we need to know how to drive the car.
The driver's manual. And the sources transition here into the two great religions of trading: technical analysis and fundamental analysis.
The chartists versus the economists.
Let's start with the chartists. Technical analysis. The source material gets pretty visual here. It talks about candlesticks. And for anyone who hasn't stared at a trading screen, this isn't wax and wicks.
No. Candlesticks are the language of price action. Instead of a simple line, they show you the battle between buyers and sellers for a specific period of time.
And the notes highlight something called the engulfing pattern.
It sounds aggressive because it is. Imagine a red candle, meaning the price dropped that day. Sellers were in control.
Okay.
But the very next day, a massive green candle opens lower and closes higher than the entire previous day's range. It physically engulfs the red one.
It eats the loss.
It tells you that the buyer momentum has completely overwhelmed the sellers. It's a very strong reversal signal.
The notes also mention Bollinger Bands. That sounds like a 70s rock group, but I know it's crucial for volatility.
It does, doesn't it? Bollinger Bands are like a dynamic container for price. You have a moving average in the middle, and then bands above and below that represent standard deviation. When those bands squeeze tight together, it means the market is quiet. Too quiet. It usually predicts a massive breakout is coming.
And if the price punches through the top band...
Might be overextended.
Speaking of overextended, we have the RSI, the Relative Strength Index. I love the analogy here of the rubber band.
It's the best way to visualize it. The RSI tracks the speed of price changes on a scale of 0 to 100. If the RSI hits 70, the market is overbought.
The rubber band is stretched too far to the upside.
Exactly. And physics says it has to snap back.
And if it's below 30,
oversold. The band is stretched down and it's likely to bounce up. It helps traders avoid, buying at the absolute top or selling at the absolute bottom.
But you can't drive just by looking at the dashboard. You have to look at the windshield. That's fundamental analysis, the weather of the market.
Right. The text lists the big three. GDP is the economy growing, inflation is your money dying, and employment.
But the master lever, the one that controls gravity in the financial world, is interest rates.
The cost of money. When central banks raise rates, borrowing gets expensive. Companies invest less. Mortgages cost more. The economy cools.
Which usually hurts stock prices.
For sure. But the source mentions a very specific warning signal. The yield curve.
This is the one that always makes headlines. The yield curve has inverted. It sounds like something out of a catastrophe movie.
And for good reason. Normally, if you lock your money away for 10 years in a bond, you get paid more interest than if you lock it away for 2 years. That makes sense, right?
Sure. More time, more risk, more reward.
An inversion is when short-term bonds start paying more than long-term bonds. It means investors are terrified of the near future.
They think things are about to get really bad, really fast.
They think, I'd rather lock in a lower rate for 10 years because I think rates are going to crash soon. Historically, an inverted yield curve is a terrifyingly accurate predictor of a recession.
And then there's the factor you just can't predict with a chart or a spreadsheet. Geopolitics.
The risk aversion event. The notes use the 2019 Saudi drone attacks as the prime example.
I remember that. Oil went crazy.
It spiked 15% in a single day. That wasn't because of an RSI indicator or a GDP report. It was a literal explosion that threatened global supply.
That's event risk.
And when that happens, capital flees to safety instantly, gold goes up, treasuries go up, and risky stocks crash.
So let's pause. We have the microstructure, the engine, we have the analysis, the manual. Logic would dictate that if you study this, memorize the patterns, watch the news, you should be rich.
Logic would dictate that, yes.
But the sources have a whole section dedicated to the human glitch, trading psychology, and it seems like this is where the car usually goes off the cliff.
It is. The text is brutal here. It says you can have a perfect strategy, but if your psychology is flawed, you will lose. The market is basically designed to exploit human evolution.
The demons. Let's run through them. First up, FOMO.
Fear of missing out. It's just herd mentality. You see Bitcoin or some tech stocks skyrocketing, everyone's celebrating.
And your brain screams, get in.
Usually right at the very top.
Then there's loss aversion.
This is biology. Studies show the pain of losing $100 is roughly twice as intense as the pleasure of gaining $100.
So what do traders do?
They refuse to sell a losing stock. They hold it, they pray it comes back, because they cannot face the pain of realizing that loss.
Which leads to the most dangerous one listed, revenge trading.
The casino mentality. I lost $1,000. I'm going to double my bet size to win it all back in one trade. It's the fastest way to go to zero.
I really appreciated that the source material didn't just list these abstract concepts. It gave us profiles, case studies of traders who were failing and how they fixed it, like Alexandra.
Alexandra is the classic analyst. Knew the market inside out, could spot the setup, but she was labeled the indecisive.
Analysis paralysis.
Total analysis paralysis. She couldn't pull the trigger because she was terrified of being wrong.
And her solution wasn't just be more confident.
No, that never works. Her solution was structural. She focused on coding. She built an algorithm to execute her logic.
She automated her own psychology.
By removing her finger from the mouse button, she bypassed her hesitation.
Then there was the duo, Jesse and Nicholas.
The distracted. Great skills, but they were trading in a chaotic environment, losing focus. Their fix was surprisingly physical.
What did they do?
Change the environment, treat the trading desk like a cockpit, no distractions.
And Maria?
The rigid. She was the opposite of a gambler, a perfectionist. She wouldn't take a trade unless it looked 100% safe.
But nothing is 100% safe.
So she missed all the winners. She had to use statistics to prove to herself that taking slightly riskier setups, B-plus setups, was actually profitable in the long run.
It all points to this GMS routine mentioned in the notes. Growth, mindset, strategy.
It's a weekly regimen. Monday is for mindset and journaling. How am I feeling? Tuesday is for risk analysis. It's treating trading like a professional sport, not a hobby.
Okay, so we've diagnosed the problem. The market is a complex, friction-filled machine, and the operator, the human, is an emotional mess. This sets the stage perfectly for the final part of our stack, the Vortex ecosystem.
Right, because when you read about Vortex, you realize it's positioning itself as the answer to exactly these two problems: market friction and human error.
It's described as a hybrid strategy.
And that's the key differentiator. They aren't saying, let AI do everything, and they aren't saying, trust your gut. They're combining AI for the heavy lifting pattern recognition, scanning thousands of those candlesticks we talked about, with human oversight for the nuance.
The results mentioned are pretty striking. The source quotes historical returns like 68.8% and even 91.2%.
Those are significant numbers. But as a researcher, I'm more interested in how they generate value. The source highlights their tokenomics, specifically real yield.
Yeah, let's unpack real yield, because in the crypto world, yield is often a dirty word. It usually just means we printed more tokens out of thin air and gave them to you.
Which is just inflation. It
Right.
devalues everyone. Vortex is different, according to these docs. Their yield comes from actual revenue. They charge, for example, $5 per lot traded on the platform. And here is the kicker. 50% of that hard cash or crypto equivalent goes back to the staking pool.
So people are actually using the engine to trade. The system generates real cash flow. and that flows to the holders. It's more like a dividend than a typical crypto reward.
Exactly. It ties the value of the token to the utility of the trading engine. If the engine works, the token works.
And speaking of utility, we have to talk about the Vortex card, because this goes right back to the friction we started with. Usually, if I make money in crypto, getting it to a grocery store to buy that loaf of bread is a nightmare.
It's the off-ramp problem. Transfer to an exchange, sell for USD, wire to a bank, wait 3 days, explain to the bank why you have crypto money. It's slow.
Right.
The Vortex card seems to be a direct bridge. It connects the digital gains to a physical Visa or MasterCard network.
The limits are massive. The source mentions up to £100,000 monthly.
Which tells us exactly who they're targeting. This isn't for the guy buying a coffee. This is for serious traders who need significant liquidity in the real world.
They even have a tiered system, a KYC option for £99, and a non-KYC option.
An interesting nod to privacy. It acknowledges that a big part of this community values anonymity.
It provides a path for people who want to keep their data private but still access their funds in the physical world.
It does. And looking at the roadmap, they're moving from a pre-seed phase toward a DAO governance model.
Which brings us full circle. A DAO, a decentralized autonomous organization, is effectively an attempt to democratize that market structure we talked about at the beginning.
Remember the dealer who sets the rules to protect himself?
Right.
In a DAO, the community sets the rules. The protocol is governed by the people holding the tokens. It's the antithesis of the opaque, black box market structure of traditional finance.
It's a fascinating journey. We started with the microscopic rules of the order book, how the sausage is actually made. We looked at the charts, we admitted our own psychological flaws, and then we looked at a tool like Vortex that is trying to automate the hard parts and bridge the gap.
It really is a journey from the engine room to the driver's seat.
One thing that stuck with me from the very beginning of the source text was this historical shift, disintermediation.
It's the mega trend of our lifetime. I mean, we used to have trading pits in Chicago. Men in colorful jackets shouting hand signals, physically pushing each other to get a trade done.
Visceral.
Human.
And now it's silent server racks in New Jersey. Algorithms routing orders to the venue with the best price in nanoseconds. The shouting matches are gone, replaced by code.
But the underlying dynamics haven't changed.
Not at all. Fear, greed, supply, demand, the battle between the informed and the uninformed, that hasn't changed since the first bazaar in ancient Mesopotamia. It just happens at the speed of light now. Which leads to a final thought for everyone listening. We talked about the spread, that insurance premium you pay when you're the uninformed trader. If market prices are just the result of rules and risk management and this brutal battle for information, you have to ask yourself a hard question.
Are you the shark?
Or are you just paying the spread for someone who is?
Something to think about before you click buy.
Check your psychological profile, maybe look into that GMS routine, and drive safe out there. Thanks for diving deep with us.
Always a pleasure.